Hey guys, it's BA here. It's Saturday, July 22nd, 2017. I'd like to take a little bit of time to add this video to the blog, and it's part of that series that I'm writing about my new project, Project 5110. 5110. Sorry about that. And Project 5110 stands for how 5 ticks a day in 1 year or less can potentially get you to $10,000 a month, starting with a $10,000 account. So what I want to do is just show you how I arrive at that mathematically using one of my projection models. So again, not trying to sell you on anything, not trying to get you to alter what you want to do, just provide you some context so that maybe you can add some of this to your trading. But what's neat about this right here is it kind of shows you that you could take $10,000, park it in another account, continue doing what you're doing, buying mutual funds, stock market indices. You continue doing that. You know, that seems to be working. Never a down day, so you can continue doing that. You continue buying stocks, continue selling options. You could include this, and you know, in a couple years' time, potentially have a very large income stream from this type of business. Only trading a couple of hours a day, you know, if you had that much to devote to it. So anyway, purpose of this is to show you my projection model and just let you know how the math works behind what I'm telling you. Again, Project 5110, how 5 ticks a day in a year or less could potentially get you to $10,000 a month, starting out with $10,000 capital. Now, before I actually delve into this, I didn't really mean to have this up right here. Let's go ahead and bring up a chart just so you've got a frame of reference for what I trade. Now, this is crude. This is for Friday, the 21st. Friday the 21st. So it was yesterday. What I've got shown here is, you know, somewhere around 9:30 up till a little past noon, the day's activities in crude. Crude typically has, you know, 10 to 15 opportunities a day for the method I use, the opportunities as I call it, which is crucial. You need to know how many opportunities you have. I would trade, my objectives would be completely different if if all the products I traded only had 1 or 2 opportunities a day. I would approach this very, very differently. But all the products I trade that I have and I watch and I collect data for have at least 10 opportunities every trading day to take out, hit my target on each one of those. That's crucial. Each one of those opportunities, only one, gets you your trading objective for the day. So what is the trading objective? It's 5 ticks. And I know every product is priced a little differently on tick value, but out of tens of thousands of data points, I can tell you where I enter trades, 5 ticks in every market is very, very crucial. So so for crude, 5 ticks equals $50 in profits. After you subtract commissions and fees, you're left with 43. All right, 43 bucks. So what I'm going to show you right here is this is my trend model, and trend model is anything magenta means I'm only taking short trades. Anything in cyan, I'm only taking long trades. Short trades, long trades, short, long, short. Exception to the rule. So you may say, well, yeah, you've got all the right spots picked on this thing. Well, these are places where I would enter, guys. If I were to show you my model, it's very objective where I enter trades at. There's no deliberation over that point right there. So I did not cherry pick this chart. It's just a typical day in crude oil. So from 9:30 till about 11:30, you know, I've got 12, I think, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 of these before 11:30, and this is what I call the lunch hour. I wouldn't be trading even though you had 2 profitable signals there, so we won't count those. Let's say you had 10 opportunities in crude. As soon as the market opened up, you got your first entry at about 9:35, and at about 9:36 and some change, you met your profit target for the day in crude. That's it, you're done. Move to the next market if you want to, or close your computers out. You're done for the day. This method, guys, is very methodical, mechanical. It has a time factor built in, so you have to be very comfortable with that time factor, meaning that it takes time to grow into this. What you want to do with a method like this is you want to always be in a position where you're trading with the house's money. So it's going to take you a little bit of time. That initial investment you put in this account, you funded it with, it's going to take a little bit of time to get your money back. And then what you always want to be doing is in a position trading with the house's money in this account for the rest of your life. So anyway, that's what I want to show you, is how to quickly get your money back so that you can trade with house's money forever and ever. Amen, as Randy Travis says. Alright, so now you have a snapshot of what the trades look like, how quickly you can potentially get out. Guys, on average, I'm trading after hours and pre-market hours, and it's the worst time to trade. I'm averaging about 15 minutes in a trade. During market hours, the trades, you're holding them for much less time. 9:30 to 11:30 is one of the most liquid times, active times in the markets. I don't care what market you trade, what part of the world it trades in. 9:30 to 11:30. If gringos have access to that market, 9:30 to 11:30 is the most active time. If other countries' market traders are up trading when gringo is trading, it's the most active time, bar none, in the markets. I've got all kinds of data to prove that. So anyway, that's the best times to be trading in the market. Second best time is from 1 to 4 p.m. Eastern Standard Time. All right, for this example though, we're looking at 9:30 to 11:30. All right, let's go back to our Excel chart. Now, let me explain this. This is my projection model, and again, this starts with a $10,000 account. It's money that you skim off to the side that you're going to try and work. Your objective is to try to work, get your money back, so that you're trading with house money forever and ever. So how you can do that, a way to look at it is, again, this model is very flexible. You don't have to live by it. You can adjust it as you go forward. It's just a model. That's all it is, guys. So in this model, for futures and stocks, I add 1 trade unit every profitable month I have. Now this model assumes you have profitable months every month you trade. You might say that's ridiculous. It's actually not when you're trading a model like this. It's not. You might have months that aren't as stellar as other months, but it's not uncommon for people that take small chunks out of the market to have profitable months every month, month in, month out. Again, I want to emphasize that. Look at this, guys. I mean, we're entering and we're out. You're entering and you're out. Entering and you're out. You're not taking not hitting home runs. You're just stepping up to the plate, trying to get a hit, and that's it. Done. Okay, so you're in, you're out. You're in, you're out. In, you're out. In, you're out. So these are the low-hanging fruit, which is the 5 ticks based on where my model says to enter is magical. It's not magical, it's just the highest probability profit target I can hit in all of the data I've pulled off. The second low-hanging fruit planning factor I want to allow for is my profit target for the day. Okay, I've already talked to you about crude. We mentioned that that first trade was $43 after commissions and fees. We had 10 of those for the day. It was $430. So the average person was like, wow, I could have made $430. How much could I have made after lunch? Well, after lunch there were, I think, 4 other opportunities. So you're like, 4 times 43, another 160, 70 some bucks. But that's not how this model, this approach works. Okay, we allow in this model for mistakes, for market reactions, for the weird things that can potentially happen when you're in trades. We accommodate that. So in this model here, again, I'm only talking about adding 1 trade unit every profitable month, which is either 1 contract, 1,000 shares of stock. If you trade 1,000 shares of stock, that's for a little bit larger accounts, but that's considered 1 trade unit. All right. So in the left-hand column here, I've got the month 1 through 24, 2 years. This column is how many symbols you trade. Again, this is a projection model. If you've got time, you're really good at this, maybe you could trade easily 2. Maybe 4 is your max. Maybe 3. Somewhere 2 to 3 is your max that you can trade. It's very seldom you're going to have more than, with 4 symbols, what I've found is very seldom you will have more than 2 trades on at any one time. So so it's within the realm of possibility that you could trade more than 1 symbol, but we're going to use 1 symbol as our planning factor here, just to show you, how small numbers can add up over time. All right, so this column is number of symbols. This is trade windows. This is making the assumption you can trade all day long, 2 hours in the morning and a couple of hours in the evening. That's it. This is how many contracts per trade. So this assumes right now that every month is going to be profitable. How profitable? Doesn't matter, just profitable. And you add. You just want to make sure that your total account value in this column is less than the number of contracts you're trading versus margin requirements. So if I'm trading crude oil a lot, it's roughly $3,000. So if I'm slinging 10 contracts here, I want to make sure that I've got roughly, somewhere around $30,000 in the account. So that's basically what you have to watch for when you're like, oh my God, you're trading as much as you have in your account value margin. Yeah, but just keep in mind, guys, this account is designed for that. This is not your only, you continue doing what you're doing in the market, buying mutual funds, buying stocks, selling options. Don't stop doing that. This is just something different that you want to try to get to in 2 years, where you can have a potentially substantial income from. All right, so this is all this in yellow. Those are inputs that I can put in and make my projections off of. We'll do a couple of those. So this column here is potential per week, potential profit per month, cumulative profit. We've got monthly return on capital in this column, and then we've got total return off of your original investment over in this column. Okay, that's a brief explanation of the spreadsheet. So now let's take a look at it. All right, we're going to use 1 symbol. Let's say 1 symbol, you are trying to take a total of 20 bucks out for the day. That's it. $20. You're like, oh my gosh, that's ridiculous. Just stay with me. So it's assuming you take $10 out in the morning, $10 out in the afternoon. Now it doesn't really matter. You could hit your first trade and that's your objective for the day. And you're like, That's ridiculous. I mean, so why would you set 5 ticks as a profit target and then only try to take $10 out per trade? Let me clarify it. We're shooting for 5 ticks profit. What this model accommodates for, it accommodates for all of the mistakes, the failures, the potential unforeseen things that happen that catch you. You have a position on, you get a phone call, it's your kid, you turn away from the market, you don't have your stop set. All of a sudden, instead of your normal $80 or $90 loss, you're down $250. So what this takes into account for are those types of things. So I like to forecast very low numbers and see how that plays out after time. Real-time trading, I have my real-time model, my profit and loss model running, and I compare the two. I see where I'm at in my live trading. So currently in real life trading, this is 20. Yeah, pre-market and post-market, it's crappy trading, guys. There's just very little volume there. When markets are moving, you can nail the trades just like that. The other times, it's really rough. This is exactly what I'm averaging in pre-market and post-market trading, real time, is this figure right here. So that's why I'm using that. So let's say, for example, you're trading 1 symbol a day. You go in and your only objective, again, this is your $10 profit window, $10 profit objective per window. There's 2 windows a day, but if you're only trading 1 window, then your profit target is 20 bucks. So let's say we go in and use crude as an example. Let's flip back to that chart. 935. You enter. 936 comes out, and it takes you out at that low right there. You're actually taking your target before that low, somewhere in here. Takes you out. All right, you're up 43 bucks. You're like, great, there's 10 other opportunities, but you don't know that. You know that on average, crude's got between 10 and 15 every day. What's crucial here is that in that example I just showed you, you're done. At 936, you're done. If you're only trading 1 symbol for the day, finished. You're way ahead of your projection model. You're only supposed to be making 20 bucks, but you just racked up 43. Hey, imagine if you could do that 10 days in a row. You're going to be so far ahead of your projection model. It's unbelievable. So that's all you're really trying to take out of crude for the day is, it's not 10, it's really 20. That's all you're doing. So let's say I go in and my first trade is a loser. I take an $80 or $90 loss. I go in my second trade, another loser. I'm down 70 or 80 bucks. My losses aren't hard dollar losses, guys. They're based on chart patterns, based on levels that the market, if it gets outside of a level, I tend to I'll exit at those points. So now we've got 2 losers in this current example. Hey, I know that in crude, I've got between 10 and 15 opportunities every day that are profitable. If I've already racked up 2, hey, I know there is a very good chance I can make 20 bucks in crude before the day is over. That's what this model is all about. Doesn't matter how many trades it takes you to get to that $20. You need to know how many opportunities you have per day, what a realistic trading objective is, and that's it. So you could certainly trade every signal you get, or you could trade in accordance with the model. I tend to stay in line with the model for projections, simply because that is the lowest probability, I'd say the lowest hanging fruit as far as objectives from a trading standpoint goes. Yeah, if you could catch 10 profitable opportunities a day in crude, you would run $10,000 up into a whole lot of money very quickly. Crude right now is averaging more contracts per day than the S&P is, so you could trade a whole lot of crude contracts and not upset the market whatsoever. So S&P can absorb 1,000 contracts at the market and not even move the market at all. I don't know if I know of anybody that's trading that large in crude. I know there probably are several big traders doing that, but I just don't know. All right, so let's take a look at what we're actually talking about. $20 a day per symbol. Every month we go in, we chink in, we're adding contracts. All right, so at month 10, we're trading 10 lots in our symbol. We're making $4,000 a month. One symbol taking $20 a day out. 5 ticks. I mean, that's what we're talking about, guys. Taking 5 ticks out of the market. Now you're already up to $4,000 bucks. I mean, you're making a month right now a 40% return on your original investment. You're already trading with the house's money. In this example, you can pull your money out at month 7 and start back over again and trading with nothing but the house's money. So now you're trading for free. It's just another way to look at this. So how are you doing in month 12? So month 12, you're making roughly $4,800 a month. Again, taking $20 out per symbol, every symbol you trade. Month 24, you're getting to your $9,600 bucks. All right, so you're like, well, I thought this project you're working on is called 5110. Yeah, how 5 ticks in a year or less could take you to $10,000 a month, starting on a $10,000 account. So if you were able to do this full time, and let's just plug in, we'll just look at some symbols here. Let's say you do 2 symbols. Two symbols a day, $20 a symbol after fees and commissions, and you're at $9,600 a month. Assuming you have profitable months every month. Now let's say if you're let's look at it another way. Let's say that you're a brand new trader stepping up to the plate, and you've got this model that you're following, or you're following me. I'm giving you every trade. You decide you're just going to trade a year, one contract. Just get the feel of it, because it never changes. We are in the most complacent marketplace in history. Volatility in everything, minus a few currencies right now, is at historical lows. And I'm averaging 10 to 15 trading opportunities every day in the markets that I follow. When, not if, but when these markets return to just normal volatility, the trading opportunities are going to be just off the charts. When we get the first down move and we get into a bear market, the trading opportunities are going to be, oh my gosh, unbelievable. If you could get to the point where you could just trade four symbols a day, I mean, the potential it's staggering, guys. I mean, it really is. You can see right now, hopefully you can see how just $20 a day per symbol is how that can get you to, you know, roughly 10,000 a month. Guys, these are not pie in the sky numbers. This is not catching every major big move in the market. We are just hitting small chunks in the market every single day in this strategy right here. So it doesn't take cat-like reflexes to get in and out. You may be thinking, oh my God, I mean, you almost have to have this computerized to get. No, you really don't. It's not that intense. You just have to recognize the signals, make the entry, put your target in, and just sit back and monitor. Look at charts for other trade setups. That's all you have to do. Let's say you're really good, and let's say you're trading 4 symbols a day. Hey, you get to 10,000 a month in, you know, almost 6 months, guys. So I mean, it's staggering. And like I mentioned in one of the other articles, what if you traded in a team and could trade 20 symbols a day? You know, hey, what if you had access to unlimited capital? We actually do as retail traders. There's one outfit out there. I've mentioned this to several of you before, Bright Trading, that focuses on stocks. You access their capital. So what if you traded in a team and could trade 20? Could identify 30 of these, and you had unlimited capital to trade stocks on. They don't do futures, but you get access to their capital to trade stocks. You know, the possibilities are endless. Again, this is working in the market. You have to be there. You can't place a trade and go off and do other things and come back and cash the checks in. You got to be there in front of the screen watching the markets. It's the only fallback to this method, but the potentials are huge on the profit side. So again, guys, this is a capital projection method that I use to arrive at some of the numbers I've been talking about in my blog on Project 5110. So to summarize this, again, I'll keep harping that you have to have a method that you can use to capture these moves. It has to be a method that you're comfortable with. It has to have a statistical edge, meaning that you, over time, you have either a high percentage of winners or a lower percentage of winners and a higher profit per trade than the higher probability variant does. So you got to have the statistical edge in order to execute something like this. And if you don't know what that is, then you don't have it. It's like being at playing poker with a group of guys. If you don't know who the patsy or the fool is, then it's probably you. So you have to have that. You have to have that edge before you execute this, and then you have to have what I think is a very disciplined approach. Again, you're trying to specialize, carve a niche out of the market. Forget about all the hubbub, the talk. You don't even need that in this type of method, guys. You just trade what's in front of you. You wait for the markets to open. You wait for your setups. You close out in the evening, win, lose, or draw. Wait for tomorrow. So it doesn't matter what the government's doing, what the crude reports are saying, what central bankers are doing. You just trade what's in front of you and let volatility direct your trades. So that's a look under the hood of what I've been talking about. Hopefully you've found this interesting, and I think that's a wrap for this video here. So anyway, guys, appreciate you watching, tuning in, and happy trading. It's BA signing out.